Did you know that if you invest $500 every month starting at the age of 35, with an average return of 8%, by the time you reach 65, you will have a whopping $1.2 million in your bank account? Such is the magic of compound interest. Now, you might be wondering, what exactly is compound interest? Well, in the simplest terms, compound interest is the interest on your initial investment, plus all the interest you've accumulated over time. It's like a snowball rolling down a hill, growing bigger and bigger as it picks up more snow. Here's an example to illustrate how powerful compound interest can be. Let's say you start investing $500 each month at the age of 35. At an average return of 8% per year, by the time you retire at 65, you would have accumulated over $1 million. That's right, over $1 million from a monthly investment of just $500. Now, what's the secret behind this impressive growth? The key lies in the combination of two crucial factors: time and consistency. The longer you allow your investments to grow, the more your money can compound and multiply. And being consistent with your investments, regardless of market fluctuations, ensures that you continually add to this growing snowball. So, what does this mean for you? Well, the biggest takeaway here is that it's never too early to start investing. Even if you're already in your mid-30s, starting now can still lead to substantial growth over time, thanks to compound interest. Remember, compound interest is your friend when it comes to investing. It's a powerful tool that can help you build wealth over time. And the best part, all it requires is a little bit of patience, consistency, and time. So, the earlier you start investing, the more time your money has to grow, thanks to the power of compound interest. Putting all your eggs in one basket is never a good idea, especially when it comes to investing. It's an old adage that holds a lot of truth. If you're serious about building wealth, diversification is the key. But what does diversification really mean? Well, in simple terms, it's about spreading your investments across different asset classes, sectors, and geographical regions to reduce risk and increase potential returns. Imagine you're a farmer with a plot of land. If you plant only one type of crop, a single pest or disease could wipe out your entire harvest. But if you plant a variety of crops, the loss from one crop won't be as devastating. Similarly, in the world of investing, if you put all your money in a single stock and that company goes under, you could lose everything. But if you diversify, you spread the risk among various investments. So how does diversification increase potential returns? Well, different asset classes and sectors perform differently under various economic conditions. Some might do well when the economy is booming, while others might hold up better during a downturn. By diversifying, you ensure that you're not entirely dependent on any one type of investment to generate returns. Now, it's important to understand that diversification isn't just about owning different stocks. It also includes other asset classes like bonds, real estate, commodities, and even cash. Each of these asset classes has its own set of risks and returns. By investing in a mix of these, you can create a balanced portfolio that aligns with your financial goals and risk tolerance. But don't forget, diversification isn't a one-time exercise. It's a dynamic process that requires regular review and rebalancing. As market conditions change, the value of your investments will fluctuate, affecting the balance of your portfolio. Regularly reviewing and adjusting your portfolio helps maintain the desired level of diversification. Remember, a well-diversified portfolio can help you weather the ups and downs of the market. So, don't put all your eggs in one basket. Diversify and give your investments the best chance to grow. Investing is not a one-time event, it's a journey that requires consistency and discipline. Let's delve into the importance of regular investment. Imagine a gardener who plants a seed and then leaves it unattended. It's highly unlikely that the seed will grow into a robust tree. Now consider this in terms of investment. Like the gardener, you need to nurture your investments regularly for them to flourish. One of the key benefits of regular investment is what's known as dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. Over time, this approach can lower the average cost per share of your investment. Let's break it down a bit. When you invest a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. This can help mitigate the impact of market volatility on your investments. You're essentially smoothing out the highs and lows of market fluctuations. Moreover, regular investing can be a feasible strategy for most individuals. You don't need a hefty sum to start. It's about starting early, investing consistently, and allowing your money to grow over time. This is particularly beneficial for those who are in the early stages of their careers, or those who do not have a large amount of disposable income. Lastly, regular investing fosters a disciplined approach to wealth accumulation. It's like setting an automatic pilot on your finances. You're less likely to be swayed by short-term market trends and more likely to stick to your long-term financial goals. So, don't be like the gardener who plants a seed and forgets about it. Be the one who nurtures it regularly. Remember, Rome wasn't built in a day, and neither is wealth. Consistent investing, regardless of market conditions, can lead to substantial wealth accumulation in the long run. So, start today, invest regularly, and watch your wealth grow over time. Every investment comes with some level of risk, but did you know that higher risk could potentially lead to higher returns? Let's take a moment to delve into this fascinating relationship between risk and return. It's like a high-stakes dance, where each step could lead to a stumble or a spectacular twirl. The risk is the possibility of losing some or all of your original investment. On the other hand, return is the money you expect to earn on an investment over time. Now, imagine you're at a fair, where you have a chance to win a giant teddy bear if you toss a ring around a bottle. The higher the risk of missing, the greater the prize. Similarly, in the world of investment, the higher the risk, the higher the potential return. But remember, just like the game at the fair, there's also a chance you could walk away with nothing. So, how do you decide how much risk is right for you? This is where the concept of risk tolerance comes in. Risk tolerance is a measure of your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Some people are thrill seekers, willing to risk it all for the chance of a big reward. Others prefer a more cautious approach, opting for investments that offer steady but smaller returns. Your risk tolerance is unique to you, shaped by factors such as your financial goals, how much time you have to invest, your financial capacity to absorb losses, and even your personality. It's important to understand your risk tolerance because it can help guide your investment decisions. For example, if you have a high risk tolerance, you might be more comfortable investing in volatile markets or high-risk securities. But if you have a low risk tolerance, you might prefer safer, more stable investments like government bonds. In conclusion, risk and return are two sides of the same coin. A higher risk could potentially lead to higher returns, but it's essential to understand your risk tolerance before you dive into the deep end. Understanding your risk tolerance can help you make informed investment decisions. While investing may seem daunting, you don't have to go it alone. Financial advisors can guide you through the process. This is a sentiment that many seasoned investors and financial enthusiasts can attest to. Financial advisors play a crucial role in shaping your investment journey, acting as a compass in the often complex world of financial markets. One of the primary roles of a financial advisor is to help create a personalized investment plan. This plan isn't just about throwing money at various assets or jumping on the latest trends. It's about understanding your financial goals, your risk tolerance, and your timeline. It's about crafting a strategic blueprint that aligns with your unique circumstances and aspirations. And who better to help with this than a financial advisor? Financial advisors have a deep understanding of the financial landscape. They are well versed in the intricacies of various investment options, from stocks and bonds to mutual funds and real estate. They are adept at analyzing market trends and can provide expert advice on where to put your money to get the best possible returns. Moreover, financial advisors can help navigate the complexities of the financial markets. They can interpret financial jargon that may seem like a foreign language to the uninitiated. They can guide you through the process of buying and selling assets, ensuring you understand the implications of each transaction. And when the market takes an unexpected turn, they can provide reassurance and guidance, helping you to stay the course and not make impulsive decisions that could jeopardize your financial future. With the right guidance, anyone can become a successful investor. The world of investing can be complex and intimidating, but you don't have to tackle it alone. A financial advisor can provide the expert advice and support you need to navigate the financial markets confidently and make informed decisions that align with your financial goals. So why not consider seeking professional advice on your investment journey? After all, every successful journey starts with a good guide.